All right. We might need to leave one seat for Crystal, but it's okay. We can switch around when she's here. Every time I moderate a panel, the longest session is always the one before lunchtime. So we are the last panel before lunchtime, before wrap up morning. Thank you everyone for coming today. I'm Andy from HashKey. I'm one of the partners here running tokenization. For those that don't know HashKey, we're a digital asset group based out of Hong Kong with digital asset exchanges, tokenization, and the Web3 ecosystem. This is one of the most interesting topics this week. I'm certain a lot of people, when you walk around consensus, everyone's talking about three key things: institutionalization, regulations, and also RWAs. But are these actually investable assets? This is often a question that we get from our partners and also people when I talk to them on the conference floor. So really thankful for having four really esteemed panelists today to actually demystify this whole thing. So joining me today, we have Melvis Langyintuo, Executive Director of Canton Network, Philip Rage, Head of Underwriting for Soter Insurance, and also Julia Miao, Deputy CEO and CFO for Sihuan Pharmaceutical. We'll also have Crystal joining us shortly. But before we start, panelists, could you guys please briefly introduce yourselves a little about your company for the audience? Thank you.
Hello, everyone. My name is Melvis, and I'm the Executive Director of the Canton Foundation. Canton is a public permissionless blockchain that was purposely built for institutional finance. We uniquely combine configurable privacy, controls, and also interoperability to enable any institution, enterprise, or even entrepreneur to launch blockchain applications that can be private, public, or a mix of the two. Today, some of the core use cases have been around payments with privacy, collateral mobility, real-world asset tokenization, all the way to DeFi primitives and the likes. Looking forward to expanding upon this and talking about some of our partners that we have on the network. Thank you.
Thank you. All right, Philip.
Hi, everyone. Philip Rage, Head of Underwriting at Soter Insurance. Soter Insurance is a Bermuda-domiciled IIGB licensed insurance company. We're solely focused on digital assets and ensuring the infrastructure that is basically underpinning a lot of what we're talking about today. What we do differently is we actually denominate our policies in digital assets themselves. So currently we write policies in US dollars, USDC, BTC, and ETH, with the idea that it's a much better asset liability match for when there is a breach or a sort of risk event. Yeah, really excited to have this discussion.
Thank you. All right, Julia.
Hi. Yeah, actually, I'm from Hong Kong. So Sihuan Pharmaceutical is a listed company in Hong Kong. We are currently the leading player in medical aesthetics and also the biopharmaceutical. So I'm here actually to explore the opportunity of making pharmaceutical IP to be RWA. So I'm here to discuss with you about how to look at this direction and whether there's a big potential on this side. Yeah.
Awesome. All right, thank you so much. All right, this panel will be done very differently than probably you've all experienced. So I will ask a question to all of the panelists today. I will ask them first whether they agree or disagree with the statement, and then they will give their answers, and I will essentially have a really enjoyable conversation.
Yep.
Panelists also, friendly debates are also encouraged. Okay, thank you. All right, so first question. HashKey, we're based in Hong Kong, but one of the things we often get asked, especially this week, and people ask this question, is Hong Kong's regulation clear? Or is Asia in general have clear regulations? Because for a lot of them, the idea of tokenization is the issuance of security tokens, and they want to make sure that the regulations are clear before they proceed. So we also see that not just Hong Kong, but in Korea, Japan, the US is also enacting Clarity Act. A few things happening in Europe and MICA as well too, and the UK. So the question is, for institutions to proceed, is it necessary to have a much more clear regulation than what we have today? Do you agree or disagree?
Yep.
All right, Melvis, let's start with you. Let's answer first.
So for this first one, I neither agree nor disagree because within Canton and what we built is, we built it from the ground level up, thinking through build the infrastructure that will be able to sustain any type of regulatory regime.
Yep.
In the sense that over the past 10 years, we've been building Canton. We launched it in mainnet during the Biden administration. And yes, it's been great that, at least in the US and other regions, we're getting more clarity around crypto.
Yep.
But it comes down to the fact that you need to not try to launch a technology or an asset and then try to figure out how to bolt it onto the existing regulatory climate. And so for us, it's been being able to think through what are some of the core challenges and potential use cases that may come into play when large institutions or regulated entities, products, and assets are coming onto the blockchain, and having the infrastructure to be nimble enough to facilitate these types of activities. And so with that, within our tech at architectural level, it enables for sub-transaction level privacy and controls to be built in, but then still have the core value of blockchain, which is the composability and enabling the interoperability of different assets. So it can fit the local regimes or even international regulatory regimes as well.
All right, cool. Philip, do you agree or disagree?
I agree.
You agree? Okay. Julia, do you agree or disagree?
Yeah, for sure. Actually, on 6th of February, right, there's a new policy recently issued, right? The government actually gave a very clear statement that there's a way, a door for RWA to be, coming. Yeah, so this is a very important day indeed. We call it the very beginning of RWA world. So I believe that, I agree. Yeah.
Philip, why do you agree then?
Because if we think about RWAs and we think about sort of the traditional financial institutions, they're going to start playing in the space. We talk about institutional capital. They need clarity. They need understanding of the regulatory environments they're working. We already see, I suppose, regulatory arbitrage across the world. People moving to Abu Dhabi, Hong Kong, etc., where there is more clear regulation. I mean, the US has now obviously changed its stance pretty heavily, and you're starting to see more people building out there. But people don't want to build in areas where they don't have regulatory clarity. So therefore, having that clarity does enable more to be built and allows people to build on Canton or allows people to tokenize IP. So I think that's why the regulatory clarity is so key, because realistically, we're dealing now more with regulated institutions than we were previously.
Okay. I was hoping for someone to disagree, but that did not happen. Okay. All right, cool. But just a reminder, panelists, just answer, agree, or disagree first. All of you, let's go through answers first, and then we'll ask some details. Okay.
So just agree or disagree first, and then
Exactly. Yes. No problem. All right. Second question. All right. So this is an interesting one. So I'm certain a lot of people have the same question: which chain should I issue my asset on? Which one is the most compliant? Which one's the most safe? Which one is the one I should put my trust on? So this is a question that we get a lot of people, and there's two camps. Usually they want to say would go with the public chains public permissionless chains that we go for, like your likes of Ethereum, Solana, etc., or they should go on a private chain, like for the likes of HSBC Orion or GSDApp, which Canton powers. So the question is that, should they be issued on a very focused or specialized chain, like say, like more focused on privacy, more focused on payments, or they should be issued, or is that the case for institutions to consider? Do you guys agree or disagree?
I disagree that it should be on a focused chain.
Okay, got it. Okay, Philip?
I'm going to have to be the same. I actually disagree.
Okay, disagree. Julia?
Sorry, I'm a traditional, company, so we think I agree.
Okay, got it. So a bit more neutral. All right. Why do you?
Yep.
You guys build a lot. You guys power a lot of the chains that is really focused though. Like even HSBC Orion focus on really serving the clients. GSDApp does similarly as well too. Focus on serving institutions and the issues of Hong Kong government debt. Why do you disagree?
So the reason why I say I disagree that it should be solely focused is because, end of the day, as I said earlier, the core value is the composability. You should be able to be nimble enough to potentially move and expand your business from that initial focus to being able to transact and engage in DeFi, for example.
Yep.
And so by the way that we are structured here at Canton is that anyone can create their own sovereign subnet and have their level of configurable privacy controls, and then also be able to eventually choose to, if they want to interoperate with any type of other application or asset on the network. And so by it being very focused, there's always trade-offs that you need to make, in the sense that, for example, if it's focused to the level where it's on a private permission chain, even though you get privacy and controls, you're missing the ability to have the ability to interoperate your assets with others across different regions or even across different types of products and verticals. And then if you go only on a public permissionless chain, guess what? end of the day, you don't have the privacy and control should you need to be able to facilitate some core regulatory requirements around privacy. And so by it being very, very binary, public permissionless, private permissioned, you're missing the ability to easily interact and be fluid with what traditional life is. It's pretty, life is more heterogeneous versus always picking one side or another. And similar to, for what we think the largest public permissionless entity is in the world is the internet, in the sense that with one browser, you can go to a private website like a bank account. And then with that same browser, you can go to a news website, a sports website, which is public. Same thing within our network is that with your Canton wallet or node, you can go to the HSBC application or JP Morgan applications. And then with that same node, you can go to a DeFi lending pool or a DEX and perps and prediction markets. So being more nimble and not being bucketed in one versus another is very important.
Got it. Okay. Philip, why do you disagree with the statement?
I mean, Melvis has done a really good job of explaining why, but I think the other key point, well, when we talk about composability, it's liquidity. Yep. And just because you token, one of the big promises we always hear is tokenization brings liquidity, but that liquidity in your eyes if there's a network effect and there are more people to actually share those tokens. So if you are tokenizing on a private blockchain, and you're sort of already narrowing your scope of people that actually you can trade with, let's say if you're creating a secondary market. So the liquidity factor, I think, is the main sort of driving decision for myself as to why people should be building on permissionless. But then, like as I was saying, the Canton Network allows that composability already, so it works quite well.
Got it. Okay, liquidity issue. So we have composability, liquidity. Julia, as a company who's well known in the space, if you were to issue an asset, would you prefer something more private, or do you want something more permissionless where everyone can get access to?
And RWA is only at the beginning in Asia, in Hong Kong especially, right? So people think this is a very new thing. So as a new company to try this the first time, we want people easily recognize us and find us, or maybe lift up our, branding, you know what I'm saying? So we need a big famous chain to really lift up our name on this space. So this is why I think a very specific chain is very important to us, not like any kind of a chain, yeah.
Well, I mean, most of the things are issued on Ethereum or public or permissionless blockchains today. So, but we also see things that's in different spaces. Let's just see how the world will evolve as we go. But that actually brings the really fundamental question as well too. So you were talking about composability, you were talking about liquidity, and also you're talking about the issuance of assets to make sure that somewhere in brand name is. What about the investors? Right. This is as asset issuers or as infrastructures that support asset growth. You need to think about who the investors will be. And a lot of the RWAs today or tokenized assets today, I think one reason people think it's not investable because they can't get access to it. It's really, really for accredited investors or professional investors, even just institutions only. So the question is, in the future, should retail investors be continued blocked? Because that's where the question, a lot of them can't get access to these instruments today. They're still blocked. But should they, in the future, continue to be blocked to get access to some of the highest quality assets that's issued on different chains? For example, institutional credit, right? They can't really invest directly on institutional credit. Treasury repos, things like that. These are, retails can't invest directly because a lot of it is really how regulation is being shaped today. So do you agree that retail should still be barred, or do you disagree?
Disagree. Retail shouldn't be barred.
All right, cool. Philip?
Yeah, disagree. Retail
disagree? Okay. Julia?
Oh, I also disagree, yeah.
You disagree? Damn it, my questions. I was hoping for debate. All right, fine. Mel, why?
Yeah, so just generally, it's not necessarily that retail are barred from these assets. It's just that we're still in the early innings of these real-world assets coming on chain. And within it, these types of assets are more institutional-based at the beginning. But then over time, they're going to eventually be able to unlock the capital efficiencies and operational efficiencies that retail may also be able to tap into. You mentioned repo transactions on chain. Yes, they're happening, but then the aspect of it that many people don't understand is that it's actually engaging with repo to some degree, in the sense that at the end of the day, the number one product market fit in crypto has been stablecoins, right?
Sure.
So with stablecoins, at the end of the day, the issuers do a lot of creation redemptions for enabling the ability to buy treasuries in order to back these assets for that attestation of what they really have in terms of the one-to-one component of these these treasuries for the US dollar backing on chain. And in doing so, for example, within Canton itself, we've been working with the DTCC, which is the largest centralized securities depository in the world, with over $100 trillion worth of assets, and they've natively tokenized treasuries on Canton. The great thing about doing this is at the end of the day, they can then be able to enable people to create mints and buy and sell these assets with stablecoins. So in the future, this unlocks the ability for stablecoin issuers to have a better realm and have faster ability to finance and create redeem for those underlying stablecoins that they're proliferating within the greater crypto ecosystem. So although retail isn't involved in it, they are the underlying end user of stablecoins as well. And then beyond this too, with regards to tokenization of equities are already happening. In the future, these tokenized equity assets would also be able to tap into DeFi, where people could use them to do things such as quote-unquote securities lending, or being able to borrow land in DeFi protocols, and also pledge it for collateral in different DeFi engagements. So it's early phases. That's why it's mostly institutional. But the end outputs of how retail can get involved are already starting to happen and will eventually happen as well.
Philip, you guys underwrite a lot of these instruments, I'm certain, or for insurance as well too. What do you guys feel?
I mean, it's funny. I almost wanted to switch my answer halfway through that, just to sort of start the debate. But I think one of the reasons that retail often hasn't had access to these sort of instruments is because of the administration costs to sort of the large asset managers when they look to actually tokenize these sort of things. So there is that element of social inclusion when you look at sort of tokenization in real world assets. All of a sudden, someone can buy a fractional share of a T-bill, for example, in sub-Saharan Africa. So that's a great positive, but at the same time, coming back to that first question around regulatory oversight and regulatory clarity, making sure that there is regulatory clarity over these essentially investment products, we're talking candidly, because some retail, like they're not professional investors, they need to be aware of the risks and exposures. So making sure that we balance that with also that sort of social element, I think is really key.
Got it, okay. Julia.
Yeah, for me, the answer is very easy indeed. You see, the drug IP, even the professional, many of them don't understand it, right? No matter saying the retailer. So for us, you have to understand the asset before you can really invest in these assets. So I think it's definitely for professional, for institution only, indeed. Okay. And also the drug IP usually worth like 100 millions, millions, billions of dollars. So it's definitely for institution, not for retailer. Yeah.
So I guess the conclusion is really depends on the types of assets that we're dealing with, and actually,
agree.
Ultimately, same risk, same business, same types of I guess access for different types of investors that we should be aware of. This actually opens up my next question. Actually, you mentioned DTCC.
Yeah.
As for those in the audience that doesn't know, the whole world is looking at tokenized equities, and a lot of these New York exchanges are looking to how to modernize the infrastructure. But a lot of tokenized assets today, we have an issue. We have two ledgers. Like we have to follow whatever is in the rules today. So as an example, right? So say if I do equities, tokenized equities, I still have a lot of people, how their model works is that they custodize these equities in the accounts and they issue a token now. So they still have to maintain, the transfer agents themselves still have to maintain a ledger while making sure that the number of tokens in their vaults, in their accounts is equal to the number of tokens on chain. So this actually creates a lot of operational hurdles. But one important thing as well too, because a lot of these assets, and not equities, but say funds, for example, a lot of these tokenized funds, they are customized to exchanges. They're, no one can take them out or hold on to it, or they can't subscribe to it. So on the blockchain, what you would see is this little token with no money in there. It just says number of tokens there with no dollar value, right? So that actually creates an issue because for blockchain, for those in the audience that don't know, we actually look at how much money is what we call TVL, that's locked, the money locked in contracts, to see how trusted or how worthy it is for us to put money in. And oftentimes this doesn't happen when you actually have these tokenized assets. So the question is, this is one of the reasons why people can't invest in, like make it would think it's not investable, because if there's, I know there's money in there, but I don't see it. Yep. How can I trust this? So do you agree the fact that for RWAs to be truly investable, all the assets, everything related to it, not just how much money locked into it, but also its performance. For example, what is the default rate of this, how healthy this asset is, must be visible on chain to everyone, even for anyone that's really wants something to be private, so that to make this an asset investable. I don't know if I was clear enough, but do you guys agree?
I strongly disagree.
You disagree?
Yeah.
Okay, so you don't need everything on chain. Okay.
I disagree.
All right.
Yeah.
Oh, no, you mean on-chain? You said public, right?
So all the performance data to be on-chain, to be public, because most of the times you actually, so if
You say on-chain and public, or just on-chain? They're two different things.
On-chain and public.
I disagree.
You disagree? All right, cool. All right. Philip, any thoughts?
Yeah, I'm sort of torn between the two, to be honest, on this one. I'll disagree on this one, unfortunately.
Disagree as well too?
Yeah, I also disagree.
Okay, so we should not have the on-chain data public to everyone visibly. Okay. Let's start with the issuer first. Let's just start with that first. Why, Julia, do you disagree with this statement?
Those are, the intellectual property are highly confidential. So, we only want to open that to people who knows how to appreciate rather than anyone on the road. So it's definitely no answer for this, yeah.
Okay, Philip?
Maybe I was misunderstanding the question. I don't think it's required for data to be published on chain. It's probably a better way of phrasing it. I mean, we already see people investing into things or buying meme coins, etc. So debate whether that's an investment or not, but there is no sort of financial data associated with that. I mean, you do get the TVL, you can see how much value is in there, but we're not getting that sort of data feed, I suppose.
Yep.
Yeah. Oh yeah. For me, I disagree with that in the sense that yes, the data and information should be on chain because it unlocks capital efficiency, operation efficiencies, but it shouldn't be on chain and public all the time. Because at the end of the day, people like their privacy, right? It says who wants to, for example, have all their salary data or activities fully public for everyone to see. And on top of that too, with regards to real world assets, many institutions, pretty much all of them, are heavily regulated and have some regulatory requirements and even some client private confidentiality clauses that they need to abide by. And they cannot have all of their on-chain real-world asset activities to be fully public for everyone to see. On top of that, it can also cause a lot of issues around front-running and people doing nefarious activities. And lastly, if you are a business and you're in a competitive business, you don't want all your vendor payment activities, all your internal activities around cash management, liquidity management, treasury management to be public for everyone to see, especially if you're doing things and then you have the quarterly earnings and reports to do. Guess what? That is going to really shake up the activities around your business itself. So being able to enable a blockchain like Canton to be able to have the public, the ability to have selective disclosures around when and who can see what they need to see when they have to see it is very, very valuable versus just having your whole life publicly visible for the whole world to see at all times.
Okay. All right, fair point. I'll take this answer. Yeah. For us, I think, as a crypto founder previously, one of the things that we enjoy is being able to see all the transactions, all the money, and what's happening on chain. But I do understand that maybe these are institutionalized and securities. There's certain privacies that we should be aware of, making sure that not everyone can get access to all the data, but maybe some of the things that will help them make a decision. For example, how much money is locked in the contract, and enable them to actually make that decision whether or not they should continue to put money in.
But then again, outside of that, if the asset has an issuer, it inherently has some private parts to it, right?
Fair point.
If it has an issuer, other than Bitcoin itself, which is fully fair launch and stuff, but if it has an issuer, it could be closed down or or censored one way or another. So yeah, it's quite interesting.
Got it. Okay. Okay, so we've discussed about 15 minutes of a few things as well. So I think panelists all feel that regulation today is fairly straightforward, and we can still move forward without probably waiting for regulation to be at the stage where we want it to be. Because technology evolving, actually, we can still build on top of it. And then what should we think? How we should be thinking about infrastructure, whether it's private chains or public chains, is actually quite clear to us as well too. So it's really depending on assets and what purpose you're serving to actually choose the right chains you have. Investors, obviously, you guys disagree with that retail should be blocked out, so that's clear as well too. So now, here's the billion-dollar question for you guys to make them investable or not. And actually, Philip actually hit on that point as well too. Liquidity. I think that is actually something we often get from people. Is like, who's buying these assets? Who wants to put money in? How tradable are these assets on a secondary market basis? So I think that's the thing when we actually think about equities, right? People trade equities because it's liquid. So, and that's how you see their market caps and all overall for equity markets to grow. So one quick question then. So for RWAs to reach, say, $1 trillion in total money locked into on-chain, meaning that to make sure that we have $1 trillion of money flowing on-chain, a lack of liquidity and secondary markets will be the biggest blocker for us to reach that goal. Do you agree or disagree?
Shall I go first?
You can go first. If you have an answer, you can go first.
I can see it being a blocker. Yeah.
It is a blocker? Okay. Yeah. So you agree it's a blocker?
Yeah.
Okay. Mel, Julia, thoughts?
For me, okay, yeah.
Do you agree this is a blocker? Like the lack of liquidity is because there's no secondary market trading?
I think it's a huge blocker, right?
It's a huge blocker? Okay.
I disagree. It depends on the type of asset.
Ooh, there we go. All right, I'll start with the disagree first.
Yeah, because end of the day, so putting assets on chain, it could enable operational efficiencies, not necessarily, and also capital efficiency, but some assets are just inherently illiquid, right? For example, like private credit is very bespoke, private equity is bespoke. And so versus treasuries and equities are much more liquid and fast moving. And so all those can still come on chain. So the level of liquidity or the velocity of the asset depends on the type of asset, but at the end of the day, the blockchain technology itself can enable them to both coexist. And also, depending on the type of asset, it could be one trade that happens that could be $1 billion worth on chain on day one, right? Versus others that may be small intermediary trades that end up reaching the $1 billion to $1 trillion, I would say.
Do you agree with the statement, Julia?
You know, the thing to block us, actually, the challenge I'm facing, our company is facing, is the liquidity. So we try very hard to find where the liquidity is, but I didn't find the answer yet. So for me, yeah, this is definitely a blocker.
What's the types of assets you're looking at that you find you want to that's having liquidity issues? Just out of curiosity.
You mean the RWA products?
Yes.
Like, yeah, the drug, make it a drug, RWA, the IP of drug, yeah.
Got it, okay. So that maybe falls into Melvis, your category of things that's more private.
Exactly.
Liquid. So she couldn't find liquidity.
Yeah, because end of the day, we're talking about getting RWAs to $1 trillion, right? So it could be an asset that has a lot more velocity, that needs liquidity for it to move, or an asset that just needs to be put on a blockchain for the operational efficiency or capital efficiency, and it's one trade that could be $1 billion. You know, so that's why for me it depends on the type of asset.
All right. Philip, you agree with this? You agree with the statement? Why? I just want to get your thoughts first, actually.
I think one of the things capital efficiency, operational efficiency, liquidity. These are all words that we hear when we hear about tokenization. Yeah. And I agree, though, it's a really interesting point, the idea that you could just do one very large trade, and then all of a sudden you have $1 trillion, you could do a third of NVIDIA, for example, and then you're done. But fundamentally, what is the point of then? If you're only doing that one trade, why would you utilize tokenization? I haven't really done much thinking, but I'm just curious, what are the benefits, really, if you're just doing that one transaction? Realistically, I think Tokenization is fractionalization. It's sort of much more easy to move small parts around. Like, I don't know what the upside would be from just doing that one large transaction.
So so at the end of the day, it's not just like one transaction, but it's just that the operational side of it, in the sense that potentially you're moving from legacy systems into a new form of on-chain record keeping.
Yeah.
Could be it, right?
Yeah.
And also the reporting, because some, like traditionally in financial markets, there's also a lot of intermediaries. For example, in fund management, the fund accounting and the fund admin process, there's so many intermediaries that are in between from the GPs, LPs raising capital, issuing the assets, distributing it, settling the assets, and then from there managing the distributions of eventual profits, right?
Yeah.
So if that's one trade where we tokenize that the fund, it's $1 billion fund, now it's on chain, and then over that 10-year period, we have better means of tracking these activities within a blockchain versus all the paper, email movements, and things like that. That is something that is improved. The operational, that's why I said there's the capital efficiency side and operational efficiency side, but we're talking about RWA assets coming on chain, so that is still influencing that final TVL number that you said, $1 trillion plus. That's what I mean, yeah.
Yeah, I mean, I think it's, $1 trillion.
So the operational side, there's a lot of
Yeah.
intermediaries that could be improved, yeah.
No, I agree on that point, to be fair.
Yeah.
All right. It's we're 8 minutes left. One final question for panelists as well too. So this is a question that, as a crypto founder, I love DeFi. Like, I love the efficiency. I love how instant it is. I love how quickly it is. And we also see a lot of people that from TradFi, which is what we say finance today, or the world today, are actually starting to interact with this. So that's when you mentioned the securitization of the assets, how they interact with chain on Canton as well too. I'm certain that Philip's seen certain assets as well too, as you underwrite the risk behind these assets or think about these risks, they are also interacting with DeFi as well too, in that sense, right? I talked to a lot of on-chain asset managers. They also tell me how they look at pricing risk as well too. But I think there's one fundamental question that we always ask ourselves: is it TradFi that's in DeFi, or is it DeFi that's in TradFi? Because I actually see the TradFi people getting more interested in how to leverage DeFi in driving efficiency and taking innovations and bridging them into and bridging their assets on chain versus DeFi versus TradFi trying to. Well, actually, DeFi. Sorry, let me rephrase it. I see a lot of DeFi protocols very actively go into TradFi and selling them the dream of having on-chain finance and how it's going to work and how great it's going to be, helping them bring liquidity, help them bring capital and actually bring use cases for these assets on chain, right? So that's one direction how DeFi is in the TradFi. But you also have TradFi just going out to DeFi protocols is that I want to make my assets more liquid. I want to make it more usable. I want to see how DeFi can actually. Are there any investment strategies that we can actually build using DeFi that we can't get in today's world, so they can offer to their clients as well too? So you see the two worlds kind of colliding together. So question, in your perspective, now I'm going to reverse this. I'll be a little careful when I ask. Is DeFi eating TradFi? Do you agree? Do you agree or disagree?
Is DeFi eating TradFi?
Is DeFi eating TradFi? Not TradFi eating DeFi. Is DeFi eating TradFi?
Oh no.
Not yet, no.
No?
Not close.
Not yet. Julia?
Not yet.
Not yet? Why? Okay, so you're no, and you're like, not yet. Okay, why not yet?
Well, see who is the controller of the world. The world is controlled by the, right?
Yeah,
you know
try
what I'm
it.
saying? So the boss make the say. Yeah.
Okay, all right, Philip. Why is DeFi not eating TradFi?
I think if you look at the overall total market cap of crypto is less than one of the world's largest shares. It's kind of a drop in the ocean. I mean, when we look at volumes, we need to still consider that. I think there's a lot of things that TradFi is learning from DeFi, and there's a lot of stuff that DeFi is learning from TradFi. I think a lot of the account abstraction, some of the new sort of nuances that we're seeing come out of like Aave, et cetera, where they're looking at like how to increase retail engagement, basically, how to increase interest rates on your stablecoin, stuff like that. Yeah. That is, I think, that is, I suppose, where DeFi is starting to eat TradFi, if we want to put it that way. But I think you need to take a sort of segments of the different markets. You can't. It's very hard to say, like, if we take TradFi as a whole, I don't think we can say.
So DeFi is like this little,
Yeah,
this little dot on the whole.
But then I
right?
suppose, like, there's the old sort of anecdote, like, how do you eat an elephant one mouthful at a time? And so, I mean, I think that's sort of where we're getting to. But we see it all the time. Like, we're working with lots of TradFis who are looking to deploy capital onto DeFi. We are like looking at how we secure Bitcoin as collateral by insuring it with Bitcoin. Like, we're seeing more and more people sort of looking to insure the ETH that they stake which we insure in ETH. So we're starting to see more and more of that sort of TradFi-esque risk transfer come into the DeFi space as well, which I think is really interesting.
Yeah.
Got it.
Yeah, at the end of the day, the crypto market is only $3 trillion, and then high quality.
It's gone down with Bitcoin prices as well, too.
Oh, yeah, that's the thing. And then high quality liquid assets in traditional markets over like 300 trillion, right? Yeah. So we're not there yet. I think we're just working on coexisting because at the end of the day, we're generally just renaming traditional financial concepts into the crypto world. Like securities lending is staking, looping is leverage. And then outside of that, yield farming is just structured products, right? So we're just coexisting, and at the end of the day, it won't be TradFi, DeFi. It'll just be like all fi, in the sense that we're just coexisting, working on implementing different products and assets across both sides. Because on the TradFi side, every single asset has a cash leg to it, and then on crypto, you obviously have the stable coins, and by tokenizing different assets, it can have the cash leg being a tokenized cash equivalent, treasury or cash deposits, or even the stable coin side, and then the crypto native side going back and forth would be quite seamless. And then composability is the core value of crypto, right? Enabling the atomic settlements of different assets. So I think it's just a merge of both sides versus one is actively attacking one another. Just that one has huge capital base and one is just much, much smaller.
Gotcha. I mean, look, if you read Chris Dixon, who's the founder of Andreessen Horowitz Crypto, ACNC Crypto, one of his recent essay was like, we're at the 1994 moment of where internet was for crypto today. So we're at that point where also Mark Andreessen back then famously quoted, software is eating the world. So who knows? Maybe in a few years, DeFi will eat the world. At least technology will serve the world better. Is probably the way I would put it that way.
Yeah, I think our definition of DeFi will probably change
very, very
a little bit.
Well, I think it was a little different as well too. So.
Yeah, I want to add one point. You see HashKey get listed this year so quick. Actually, this is a sign. DeFi is coming. You know what I'm saying? So otherwise, HashKey might not be, right? So I think it's coming, but not yet.
Well, no comments on the IPO related issues from our side. So anyway, last question. It's February, right before Chinese New Year. Thank you again for panelists coming all the way here, traveling across the Abu Dhabi in the UK, and giving some local perspective, Julia. If you were to give one word to a keyword that you want them to be focused on for 2026, like a theme or something, what would that keyword be? Just to wrap things up a little bit. Julia, maybe start with you.
I will use the faith. We should have
okay.
faith in this. Yeah, I'm a huge believer to RWA. Yeah.
Awesome. Philip.
Oh, you've caught me on the spot. Faith's a great one. Can I use faith?
Faith's good? Okay.
Yeah, we'll go faith.
Faith, all right.
Okay. Collaboration.
Collaboration, okay. Okay, great. With that, thank you again from panelists, Melvis from Canton Network, Philip from Soter, and Julia from Sihuan Pharmaceutical. Thank you again for your time today and for your insights. That's wraps up the panel. I'm Andy from HashKey. Looking forward to working with it. Thank you everyone for coming in today and enjoy the conference. Thank you.
Thank you.
Thank you. Yeah.
That was fun.